Hello, this is Adam Zerker with Hickson Zerker Capital Management. In today's video, we're going to take a look at the basically a quarterly review of the market and the economy. We're going to take a look at where things are and where we see things headed for the rest of the year. So to start, let's take a look at how different asset classes have performed so far this year. Take a look at last year first. Cash was up 1.8% last year, but every other asset class lost money last year, with the worst performing asset class being emerging market equities, down almost 15%. This year, cash is also up 1.8%, but everything else is up. So it's a good year for all types of investors, with the best performing asset class being real estate and the US stock market being the next best asset class, with a return of 20% so far this year through last Friday. Digging a little deeper, this is the S&P 500. Again, the market is up over 20% so far this year, with the best performing sector being technology stocks. Technology stocks are up 33%, and the worst performing sector of the year, energy stocks. Energy stocks are up just 3.8% this year. But the market has been driven by technology, real estate, and consumer staples, consumer discretionary stocks, as well as utility stocks. Some investors have taken a defensive posture and driven the price of utility stocks up. So let's step back and take a look at where we are and where we've come from. This chart shows you where the market is today, going all the way back to October 1st of last year. So just over a 1-year chart. And what you notice is that the S&P 500 in green, the NASDAQ in purple, and the Dow in white, all of those are really only up less than 2% from where we were just a year ago. Even though it's been a good year in the market and the US stock market's up 20%, what has happened is we've basically recovered all of the losses that we had in the fourth quarter of last year. If you recall, the market had hit an all-time high in September 2018, and then we had a 19% correction, with the market hitting lows on Christmas Eve and then rebounding nicely this year, hitting all-time highs most recently in July, and we are now very near to all-time highs again. As an update on the economy, this chart here shows you all economic expansions in gray and recessions in blue since 1900. And as you can see, we're currently in the longest economic expansion. This expansion is now 123 months long. It's also the slowest economic expansion. This chart shows you all economic expansions, and it shows you relative to each other how fast they've been growing. And this one's been growing the slowest, which is one reason it's also been the longest. A lot of clients will ask me, well, does that mean that we are due for a recession? Not necessarily. Economic expansions don't die because of old age. There is usually some other catalyst to push the economy into a recession. So let's take a look. Each quarter, our investment team, we sit down and we do a really thorough deep dive on the economy and the markets, and we kind of lay out the pros, the cons, and the unknowns. This chart shows you kind of where we stand on different things. I'm not going to go through every one of these, but I am going to highlight a few things. As you can see, there are more pros today than there are cons. So overall, we are bullish on the economy. We think this expansion has room to continue. But let me go ahead and show you some of the reasons why, and also some of the risks. We'll start with the stock market itself. This is a chart of the S&P 500 since 2009. So it's a 10-year chart showing you where the market has been over the last decade. And as you can see in white, the price has been up and to the right with a few bumps in between. So most recently we had a correction at the end of last year. We had another correction at the beginning of last year. Here we had one in the beginning of 2016. So you can see we've had a couple of dips along the way, but never a drop of 20% or more. Now what I like to look at is the 200-day moving average. That is the yellow line. What you see is that line is going up and to the right. It smooths out all of the daily volatility. And if you look here, we've had a couple of situations here over the past decade, really 3 periods, and the most recent period is the past year, where we've had a lot of volatility, but overall that 200-day moving average just kind of goes slowly sideways, and then now we're going up and to the right. So what this tells us is the market is still still has a long-term uptrend. The price is trading above the 200-day moving average, and that trend remains intact. So we'll continue to expect the market to go up until that's proven otherwise. With interest rates so low, another interesting fact about today's market is the dividend yield on the S&P 500 is about 1.9%, which is now greater than interest rate on a 10-year Treasury bond. So you can now invest in the S&P 500 or in stocks and get a better dividend yield than you would on an interest rate on a 10-year Treasury. That's quite a bit different from where we were at the end of 2018 when Treasuries were yielding over 3%. So you can see we've had a big drop in Treasury rates this year, now making stocks more appealing from a yield standpoint. One reason we believe we continue to be bullish on the economy is that we think that the probability of recession remains pretty low in the near term. Here's a couple of reasons why. Number one, we like to look at leading economic indicators over coincident economic indicators. And you can just see this ratio plotted here, and all you really need to know is that prior to every recession in gray, you see that indicator peak. And you see it peak and have a sharp downturn before the recession. Here we are in this expansion, and we haven't really had a sharp downturn. We have peaked a little bit and going sideways, but if we zoom in over here, we can see that we're just continuing to go sideways, and we haven't had a sharp downturn in economic indicators, and usually that downturn happens about 2 years in advance of a recession. So we will watch and see what happens with economic reports over the next year. But as of now, we remain bullish on the economy. Bloomberg's recession model also shows a low probability of recession in the next 12 months. They're currently giving that probability just 25%. And as you can see, prior to the last 2 recessions, that indicator spiked quite a bit, higher than 25% before we actually had a recession. Now the economy has slowed a bit, and a big part of that has to do with the trade war and with China. And as you can see, we had a great economy in 2017 with growth of 2.8%, much of that fueled by tax cuts. But the tailwind that we had from tax cuts is now being consumed by the trade war. As you can see, 2018 economic growth of 2.5%, and this year is projected to come in at 2.2%. So there is a slowdown in the economy, but not a negative slowdown. This chart shows you that a big reason for that is indeed the tariffs and the uncertainty that the talk about tariffs is bringing. This is the impact we are expecting on global GDP. So what you see here is the trade war is actually expected to impact the global economy by -1%. Almost half of that is driven just simply by uncertainty. In other words, businesses remain cautious due to the uncertainty about tariffs and what's going to happen. As a result of the trade war, manufacturing has also slowed down quite a bit. This is the ISM Manufacturing Index, and really what you need to know about this is a level above 50 is considered healthy, and just a year ago or so we were at 60 on this index, and now we're down at 47.8, which is the lowest level we've had since 2009. So manufacturing has slowed down considerably. The same is also true for global manufacturing. Global manufacturing has slowed down to 49.7, and you can see we've had a declining trend for the past year, leading also to a slowdown in global economic growth. So as a result of the slowdown that we're seeing in the global economy and also the US economy, and talk about tariffs and all the uncertainty, the Fed has decided to start cutting interest rates. Last year they increased rates 4 times, and this year they've cut rates so far 2 times. The federal funds rate is now at 2% after the second cut this year, and there's been quite a bit of tension between the president and the Fed, and so it remains to be seen. The economy is really pretty strong for the Fed to be cutting rates. Generally the Fed will cut rates reactively, but it seems like this time the Fed is acting preemptively, trying to avoid a recession at all. Right now, the way Fed funds futures are trading, we currently see about a 90% probability of another rate cut before the end of the year. So the Fed will meet October 31st, and we'll see if we get a rate cut then. It's likely that we'll get another 0.25% rate cut at least once this year. Also affecting the markets over the next year will be the 2020 election. That's starting to heat up with Democratic debates that we've recently had. Currently, if you look at electionbettingodds.com, you can see that Elizabeth Warren is projected to win the Democratic primary. And when you add up and you consider the Democratic bets versus the Republican bets, it's a pretty even battle right now for the 2020 presidency. Talk about impeachment also increases the uncertainty. So expect election headlines to drive the market a little bit. We will be watching this closely to see what happens, but keep in mind that over the long term, it doesn't really matter who wins the White House. As you can see here, the stock market has had positive results whether we've had a Democrat or a Republican in the White House. Remember that the stock market is driven by underlying fundamentals of the economy and business growth, and business will continue no matter which party wins the election. We're now entering the final quarter of the year, which is also known as the best quarter of the year for the stock market generally. So historically speaking, over the past 20 years, you can see that October, November, and December all have had positive results in the market at least 2/3 of the time. So 2 out of 3 years you see positive results and over 1%. And you can see that right here. These are the best months of the year for the market, generally speaking. That wasn't true last year, but from a seasonality standpoint, that's usually the case. So in conclusion, overall, we feel that the economy is in a relatively strong position. To us, it feels like this expansion does have more room to run. It feels a little bit more like 1997 than it does 2007. We also believe that we are in the best position relative to the rest of the world. We do note that the trade war with China will impact the economy, but it will impact the US less than the rest of the world. Also, the upcoming 2020 election does pose some risks in the short term, but as we know, long term, it could also create some opportunities. We will be watching to see how current trade talks turn out, as well as quarterly earnings report, which just got kicked off this week. So that's it for today's market and economic update. As always, if you have any questions at all about your personal situation or questions or concerns, please get a hold of us. You can visit our website at hzcapital.com, or you can give us a call at 419-425-2400. Thank you.